Time ago, we're going to find out from Dhirendra if it still makes sense for us to add to our portfolios. Dhirendra, thank you so much for joining us. Good afternoon. Let's talk about arbitrage funds. Now, over the last 1 year, the Nifty has given a return of about 3%. But arbitrage funds, the best one, has returned about 9%, and the category average is 8.4%. It's very similar to how a fixed income fund works. Tell us how these funds are different and how they work.
These arbitrage funds have very little to do with Nifty because typically what happens is these arbitrage funds, they don't assume risk. They try and spot an opportunity in the cash market and the future market, and they try and capitalize on any such anomaly or a price gap which could be visible on a day-to-day basis. And just in case they don't come across any such arbitrage opportunity, they invest in liquid funds, or they invest like a liquid fund or in short-term maturity money market instrument. So because the returns have been high on the fixed income, so these arbitrage funds have not been able to get a lot of arbitrage opportunity, or in between they get a little bit. So most of the return is derived from fixed income, from short maturity papers, and they can actually go little long than the absolute short maturity portfolio like a liquid fund, because the liquidity cycle required for investors is a month. So that is why they have been able to deliver this kind of return. It has very little to do with market. These funds do not assume any market risk.
Well, Dhirendra, do you recommend that retail investors consider these funds at this point, especially where the market is in terms of bond volatility still worrying the RBI? Should we consider arbitrage funds at all?
I would not suggest these funds, because these funds have now a very marginal appeal. Earlier, these funds had one attractive thing, that you invested in a risk-free investment vehicle, and the return were treated like an equity fund because they were capitalizing on arbitrage opportunity. But those arbitrage opportunity now are less than what the threshold which is needed for these funds to be treated as equity investment. So my sense is that the return from these funds will not be treated as equity investment, so it will not have the concessional tax treatment. So investors should consider a liquid fund or a short-term debt fund or ultra short-term debt fund than an arbitrage fund, because they are actually no longer an arbitrage fund.
But then, last of all, there is one arbitrage fund, the IDFC Arbitrage Plan B, that has 5 stars on your website. Tell us what sets this fund apart and what makes it a 5-star fund.
Just that it has been little more agile, and it has been little more aggressive with its fixed income investment. They have been able to, and marginal enhanced return has translated into this rating. But my sense is that this category itself has lost its relevance. It has lost its charm because of the change tax, the change tax treatment which they will all be meeting. So, despite being a 5-star fund, I think the category as a whole is avoidable.